IRDA protection of policyholders' interest, and as usual, since this is a supposedly 2 hour long session, so I will just go through bits and pieces of it and then halt, so that I will be in a position to bring some interaction or your views relating to the aspects. Okay. So first, let me start off with the Pphi regulation. So the regulation was important. There was no policyholder protection regulation prior to the liberalization of the insurance sector for very obvious reasons, because the sector itself was brought under the umbrella of the state through nationalization. First in the life insurance space in 1956 when LIC was formed, combining all the life insurers that were there and prudential life insurers that were there at that point of time. So the monopoly that was assigned to LIC and the state control over LIC was enough to ensure that this organization is now capable of taking care of protection of policyholders' interest. So there was no specific need for coming out with any specific regulations. Then the second situation is in relation to the general insurance companies, where again the nationalization through the General Insurance Business Nationalization Act in 1972 brought everything under the umbrella of GIC and the 4 companies spread across the 4 corners of the country, providing by and large standardized products. So there's no great difference in the products which are offered, and once there is no difference in terms of the products which are offered, there is no specific need of competition. There is no problem of absence of disclosure where the policyholders will be put to detriment. So in that scenario also, it was not necessary that there had to be a regulation for protection of policyholders' interest. But the scenario changed when the liberalization of the financial sector started, and insurance sector was also intended to be brought progressively into the liberalized environment. You may see that the liberalization of the financial sector took place in 1990s, but the liberalization of the insurance sector took place in the late 90s and towards the early 2000s. The reason was it was the last of the institutions which was taken up because it was under monopoly, and it was not necessary that when I am dealing with 100 other things like fiscal policy reforms, financial market reforms, then banking sector reforms where private, foreign and Indian and indigenous entities were there, that I should now go and meddle with the insurance sector also and create another structure for that. So that's the reason why the last of the sectors to be taken up for examination for liberalization was the insurance sector, and Dr. R.N. Malhotra was the chairman, was the former Reserve Bank governor, was entrusted with the responsibility, and he indicated 3 or 4 items which form the basis for the entire insurance sector as it is now. First, he said that there is too much of monopoly in it, and because of monopoly, there is absence of diverse products that are available for people. Then elsewhere internationally, there are different institutions which are offering different kinds of products, so that those innovations are not getting reflected in the insurance sector in the country. Then insurance is an area where a lot of business interest is there, and it also plays an important role in the financial sector development and also consequently the real sector development. So bringing in more capital and bringing more people under insurance is something which is very important to give that boost to the financial sector and the real sector through making available the money that is necessary for the government to do its developmental activities, because these entities tend to tap long-term resources for use to the economy. Then the participation of these entities into the financial sector also can have a multiplier effect, because of which it is now necessary that we need to go back from the 1956 and 72 mode of having a state monopolized insurance sector to a private participatory competitive insurance sector, so that the policyholder gets more choice and the sector develops in a proper manner. And with that objective in mind, they had suggested opening up the insurance sector for private participation. And because internationally they were very good in terms of reinsurance practices, product development, etc. They wanted to have foreign capital also to be coming into the country so that they will be in a position to supplement. In fact, if you remember the scenario of 1990, at one point of time, we were averse to foreign exchange going out, but we were welcoming foreign exchange coming in. But after the problem of 1990, we were welcome to foreign exchange coming in also, because only then we will have enough resources to deal with the foreign exchange to be going out. So what is the level up to which foreign exchange can be permitted was depending upon the sensitivity of the sector and the contribution of the sector to the economy. So at that point of time, it was indicated that let us not go into a very high level of foreign investment. Let us settle for a 26% limit on investment in foreign entities. That was the change that was brought about through the liberalization exercise and consequent upon the recommendations of the Malhotra committee. But now, when you're going to have participants in the insurance sector who are not government-owned entities, but you are going to have private entities, then you are also going to have multinationals who would be having an equity stake in these entities to the extent of 26% to have reasonable control over the management of the entities. You wanted to have a regulator to ensure that the business is operated in a proper manner. And secondly, and most importantly, the protection of policyholders' interest, in whose benefit the entire reforms in the insurance sector are being brought about, are safeguarded or taken care of. And that is when the concept or the thinking for having a protection of policyholders' interest regulations came into being. And that is when in 2002, the first set of regulations relating to protection of policyholders' interest came in. And as it happens in any of these statements of intent, very good statements of intent, this statement of intent also was the least touched in the entire, tenure of developments in the insurance sector and with the growth of the insurance regulatory framework. So there was hardly any modification that was brought about. You can always feel happy that it was a very well drafted regulation. But the second point of it was that considering that the insurance sector was in a growth phase and it was necessary that the effort should be more in terms of promotion of insurance interest rather than on focusing on the policyholder protection, you will find that in so many cases of the decisions that are given, etc., the policyholder protection violations are generally given a short shrift. That is, they are condoned. Even now you will find that there will be a lot of explanation which will be given and then not much penalty will be imposed against the entities. So this policyholder protection being important, that was given, but parallelly the insurance sector being promoted and promoting the insurance sector and assisting the insurers in terms of coming out with various products was more the focus rather than the protection of policyholders' interest. And that's the reason why there is no need, when you are not implementing the regulations in so strict terms, where would be the need for them to be changed in accordance with the changing time? And all said and done, this document has been very well drafted, because of which even after 2015, there was hardly much change that was brought about. The essential part of these regulations is basically in terms of implementing them in letter and spirit. And that is where most of the instances of complaints that you find, grievances that are there, etc., you find that justice is not truly and completely being done to the policyholders. So a part of the blame has to be taken by the the intermediaries. A major part of the blame has to be taken by the insurers who are interested in building their profile and competing with their own peers in the market, which is very, very competitive. And a large part of the blame has to be laid even at the doorsteps of the Insurance Regulatory and Development Authority of India, because the Act does not say that Reserve Bank, that IRDA has been set up for the promotion of insurance sector, but the Act says that it has been set up basically for the protection of policyholders' interest, and the priority at all points of time had to be the policyholder interest protection. So this is the small background with which I want to introduce the policyholder protection regulation. So an attempt to revise this regulation was made in 2015. And let me give you the backdrop of that 2015 amendment of regulations. That was, I don't know whether you are aware that there was one committee called the Financial Sector Legislative Reforms Commission. Is any one of you aware? FSLRC, Financial Sector Legislative Reforms Commission, under the chairmanship of Justice Shri B.N. Sri Krishna.
No, sir.
I would request you all to go through this very important document. This commission was set up by Government of India, and this was intended basically to have a comprehensive Indian financial code which encompasses the whole of the financial sector, and it has proposed a single legislation for the entire financial system. So that is one major thing that they have done. The second important contribution of this FSLRC, or intended contribution of this FSLRC, was to move away from a rule-based regulatory framework that is prevalent in the country to a principle-based regulatory framework. So I don't know whether you are aware of the distinction between these two. Anybody can indicate what is the difference between a rule-based regulatory system and a principle-based regulatory system? Yes.
The company, sir, Ganesan.
Yes, sir.
I am sharing my experience also, sir. Not the principle, sir, when a company is being operated under the guidelines of Articles of Association and the Memorandum of Association. Memorandum of Association has got one principle, as well as the Articles of Association has got one principle. Based on the principle, the company is being operated.
Sir, your voice is breaking, but I understand that you are talking about memorandum and articles of association.
Association where the principles are laid out for being operated of a company. Principles.
Okay. See, but that is not the intention. No? We are talking about a regulation regime, and anyone else wants to give, because the memorandum and articles of association are basically those which determine the conduct of business and the business of a corporate entity. So basically a memorandum of association indicates what are the broad objects that are there and who are the signatories to the institution, who are setting up the institution. Then articles of association delineate the mechanism in which the day-to-day processes of the company or the corporate entity will be taken forward. So, but that has got nothing to do with this principle-based and rule-based.
I am talking about principles.
Yes, sir.
Of the company, principles of the company. So that is the principle-based. And that is the principles of the company.
Okay, so you are indicating that what is written in memorandum is the principle, and what comes out in the articles is the rule. Okay, so I can a bit of an analogy, but okay. So in case of a rule-based regulatory system, you have specific provisions made for every aspect of business. Like you must have net owned fund of 25 lakhs, then you must have registration, then your management should be like this. So everything I am going to create a rule. So you will have multiplicity of rules which are supposed to be complied with. But in case of principle based regulation, what happens is you indicate a broad principle saying that you are going to have management who is fit and proper. So the principle here is the management of an entity has to be fit and proper in terms of running the company properly. So this is the principle, but how do you translate this into reality is where the fine print of this principle getting into operation will come into play. So now what you have to do? So the person has to be someone who does not have a relationship with the company. The person should be qualified in actuarial, economics, insurance, etc. So where you are not having the principle, but you are having individual rules that will drive the entire regulatory framework. That kind of a regulatory framework is what is called as a rule-based regulatory framework. And in terms of the banking, financial sector, and everywhere in our country, we are largely having a rule-based regulatory system. There is a legislation, there are regulations and rules that are framed under it, which govern every single aspect of the regulated entities operations. But in case of principle based regulation, you will have broad principles which will be operation, like your principle of indemnity, like your principle of insurable interest. So it's a broad principle. And how does the principle of insurable interest operate? You are fine tuning in terms of coming out with smaller regulation. So the intention in these two, the distinction between the two is a principle based law will be comparatively small and brief, whereas a rule based law will be very elaborate, and the intention will be more in terms of compliance with these finer elements rather than on the compliance with the larger principle which is driving these rules to be made. So that's the slight difference that is there. But if you see the the English law relating to banking, insurance, etc., you will find that the law will have principles very brief, but under the law you will have so many other instruments which are there, which will be much more than what your conventional insurance act or something else will be there. So the FSLRC suggested a shift from the rule-based regulation to a principle-based regulation. And the third important regulation that they had suggested is to have a single regulator for the entire financial system. Not single regulator from the Reserve Bank will be one regulator. Then for all the other non-payment system entities and banking entities, there will be one unified financial regulator, which will encompass your insurance regulation, securities market regulation, and the non-banking financial regulation. So this model of having separate regulatory entities for banking and payment system and for other non-banking financial intermediaries was the model that was propounded by FSLRC. So the third important aspect in FSLRC was to give primacy to consumer in the regulatory framework. So giving primacy to consumer in terms of regulatory framework was by giving certain rights which were supposed to be given for the consumers, etc. So am I on the network? Am I audible?
You are audible, sir.
Slightly some disturbance
You're
is there.
audible, sir.
Audible,
You're
but
audible.
some-
Yes, sir.
The
Yes.
slide is
Yes,
not
you're audible.
visible. The slide is not to be seen.
Okay, so there is some in between, there is some hold on connecting or something like that coming up in my PC. So this was the third thing that was brought about. So when I talk about FSLRC, there is a unified Indian financial code that they have proposed. Second is regrouped the financial regulators into Reserve Bank as a banking and payment system regulator, and a unified financial regulator to be overseeing everything other than the banks. And the third being moving from a rule-based regulatory system to a principle-based regulatory system. And last but not the least is giving primacy to consumer in financial system regulation. That is, financial consumer protection should be at the helm of affairs of and it should be the ultimate objective for regulation of the financial system. So that was the mandate that they were given, and they have indicated to all the financial regulators to say that you improve your financial consumer protection regimes so that you are giving the customers the rights that they are entitled to be given, and those rights were something which were already there in the Consumer Protection Act, and which were improved upon basically to deal with the peculiarities of financial products, like rights for small holders, etc. Then disclosure, then coming out with fair practices in terms of advising the customer properly, where he is dependent upon your advice, etc. So these kind of consumer protection mechanisms were supposed to be brought out, and the existing consumer protection mechanisms were supposed to be improved in line with the expectations of FSLRC. And in that context, you had an attempt was made to revise the policyholder protection guidelines in 2015, and I happen to be one of the members in that committee. We came out with a very elaborate document incorporating a lot of things which was not very comfortable to many, first in the IRDA and also in the insurance sector when it was put out in the public domain. So finally, some modifications were brought about in 2017, and the new regulations of protection and policyholders interest was brought out in 2017. And if you see the differences between the 2002 and the 2017 regulation, you will find that there are very few cursory modifications that have been made, not very elaborate modifications as were suggested in the document that I had referred to. So you can anyhow go to IRDA website and have a look at it for your information. So when I look back at this document, I find that it's too cumbersome. But when you're talking about consumer protection, at least if you are going to indicate the minimum relating to those aspects which have been touched in those regulations, it would have been better. But what they have done in the 2017 regulation is hived off a large chunk of it to come out with a board approved policy on consumer protection, and incorporated those elements like grievance redressal policy should be there. Then you need to have a tax for various processes that are supposed to be done, etc. Then you must come out with a rights charter for the consumers, etc. So those kind of things, where we had wanted them to be in the regulation, they have indicated that these have to be a part of the policyholder protection framework, which is a board approved policy of each insurer. So that's the small change. So then coming to the nitty-gritty of what the policyholder protection regulations are, these regulations contain the do's and don'ts for protection of policyholders, insurers at all stages of the insurance cycle. So basically, what are the mechanisms of protection and what are the ways in which the protection of policyholders' interest is supposed to be secured by the insurer or the insurance intermediaries or the agents are specified in each stage of the policy cycle. That is, first at the invitation to offer or the point of sale level, what are the protections that need to be given? Then at the proposal stage, what are the requirements that need to be fulfilled so as to ensure the protection of policyholders' interest? Then at policy issuance, what are the disclosures that need to be made in the policy? Then free look cancellation provision to come out of policy, which I am not very comfortable with. Then what is the protection in terms of a prompt claim handling by the insurers in the life, health and the general insurance space? And then what are the provisions relating to grievance redressal? So all this have been encapsulated in the policyholder protection regulation. One important difference that I can see between 2002 directions and the 2017 directions is addition of provisions relating to matters to be stated in the health insurance policy, claims in respect of health insurance policy, and one particular regulation which talks about classifying the conditions and exclusions in general insurance and health insurance policies. So these three are very distinct pluses that are there in the regulations of 2017. One important modification that has been brought about in 2017 insofar as claim handling is the facility that an insurance can give on account payment if he is satisfied that there is a ground for claim to be paid. So that is one change that has been brought about. And the other negative thing that has been brought about is there were timelines which were specified in the grievance redressal guidelines issued under the policyholder protection regulations earlier. Now what they have done is they have taken the grievance redressal and put it in an annexure, and there is no limit in terms of timelines for the various servicing and claim related aspects that are provided for. So that is one small distinction that is negative in my sense as far as grievance redressal is concerned. But as far as claim handling is concerned, we wanted to bring out a system where you do away with this last document business, but that last document, any deadline is from the last document that is furnished, and this results in a situation where the last document, if it is delayed for whatever reasons, then automatically the claim settlement goes beyond the timelines that are not normally required for settlement of the claims. So these are some of the broad distinctions that are there between the regulations of 2002 and 2017. And one more small, I can say it is only technical, addition that has been brought is the regulations earlier in 2002 indicated that they apply only to insurers. But now what they have done is it is applicable to insurers, insurance intermediaries, distribution channels, and other regulated entities. It is what is given. And similar change has been brought about even in case of the insurance ombudsman scheme, where they have been made applicable. But the instrumentations or instrumentalities in terms of bringing out and bringing these entities to the book have not been provided for, and still it is the insurer who is accountable for the lapses of the intermediaries, distribution channels, and other regulated entities. The problem with this kind of an approach is that you don't have statistics about what are the events where the customer has had a grievance with the intermediary. The statistics don't get captured. That is a problem which could have been addressed through the system, or when the IGMS, integrated grievance management system, if it is going to be, I think it is going to be revamped. If that is done, there you could have a capturing of information about the problems relating to intermediaries and problems relating to the insurers, which can be clearly brought out. So this is the small introduction. So now, in case you have any doubts, I will just halt for a moment because I have gone through for 30 minutes. Okay. Any questions, any doubts, any inputs? Yes, Sudhakaran sir.
You have told that the pointing out of intermediary insurers in IGMS. Yesterday I visited the website integrated management site of United India Insurance. Sir. It is clearly mentioned whether your grievance is against insurer, against an agent, against a broker, so what, against any other related matters. So like that, the given a frequency of tabulation is given to find out who is at fault.
Okay.
And I have also mentioned whether it is insurer means if we put policy issuance issue, then automatically it is coming to insurer. Against the commission payable to the if amount is commission is dropping to the insured holder, and the agent is automatically coming. So like that they have made it.
Okay. But one thing that I noticed is the emphasis is more on insurance grievance redressal, insurers grievance redressal, rather than on intermediaries grievance redressal. And
yes,
even
yes.
when we are there in IRDAI, the focus is more on the insurers grievance redressal rather than on the intermediaries. And in fact, we were sharing this data with our intermediaries and agents section, but there was no general follow-up, or it was not even being factored into the renewal of license of these entities. So that's where, so with the moment that you will be in a position to hit someone and ensure that they are going to be disciplined only if it has any impact on them, a monetary impact or a business impact or something like that. But with the overarching emphasis that we had on the insurers and the fact that insurers are controlling these intermediaries.
Correct.
We were going reasonably soft on the intermediaries.
Yeah.
While most of the time it is the intermediary who is putting the insurer at jeopardy because of the promises that they make or the documents that they circulate in their name.
Yeah, correct.
Yes, sir. Anything else, sir? Or do I go ahead? Okay, I will go ahead since there's Maunam Ardhangikaram. So I will take the Angikaram part of it and then go on. So now, as far as the applicability of the regulation is concerned, one thing is very important, that policyholder protection regulation is not the last word as far as measures that are intended for the protection of policyholders. So it becomes necessary to reiterate that if you are going to comply with these regulations, so you have complied with every policyholder protection regulation. No. So the regulations here are complementary to the other regulations, and fulfillment of these regulations is in addition to the requirements that are there under other regulations. Like you have your linked product and non-linked products. There are so many disclosures and other things that need to be done and followed there. So if they are indicated there, they will have to be read along with these regulations. And that's the reason why an important change that has been brought about in the insurance ombudsman rules of 2017, in the sense that earlier you didn't have a residuary provision of grievances that can be handled by ombudsman. So now what they have indicated is, in addition to these those items that are listed, if the insurer does not comply with any other regulation issued by IRDAI or direction, then also that can be a ground for a grievance against the insurer or the intermediary before the insurance ombudsman. So now virtually every grievance of non-compliance with any regulation forms a part of a grievance that can be raised before the insurance ombudsman. So that way, this aspect relating to complementarity of this regulation to other regulations is something which is very important. Then it applies to all entities in insurance business, that is insurers, distribution channels, intermediaries, insurance agents, other regulated entities, policyholders. So now you can imagine that you have an electronic insurance account and you have some problem in relation to an electronic insurance account. So being a regulated entity, the insurance repository will also form a part of the, will also come within the fold of the grievance, policyholder protection regulation. A TPA will also form a part as an intermediary. An agent or an insurance marketing firm or a common service center will also be a part of the regulation because of the expansive application of these regulations, not merely to the insurance entities, but also to the distribution channels, intermediaries, agents, and other regulated entities. And there are certain commitments in relation to the policyholders also relating to disclosures. That commitments bring these regulations applicable to the policyholders as well. Because the disclosure requirement is a two-way requirement, and the policyholder is also bound by the regulations to disclose. The objectives of the insurer of the policyholder protection regulations are first, very obvious that it is the protection of policyholders' interest. The second thing is the insurers, intermediaries, and the regulated entities are required to fulfill their obligations towards the policyholders. And then all these entities have to have standard procedures and best practices in sale and service of insurance policies so as to ensure that the policyholders have a good customer experience while interacting with them. Then the most important aspect is the governance by insurers has to be policyholder centric, and the emphasis should be on quick and expeditious grievance redressal. So that is these are the objectives with which the Policyholder Protection Regulations 2017 have been brought into force. Then section regulation 4 deals with the definition. the definition here are important definitions are complaint or a grievance. It is a written expression of dissatisfaction with insurer or other regulated entities, or of inaction or deficiency in service or non-compliance with the standard of service. So if a written expression of dissatisfaction is there on any of these parameters, it will turn out to be a grievance, and the requirements of the grievance redressal will apply in respect of such a representation that has been made. Then complainant is basically, it could be any person who has a grievance. It could be a prospect if he has a problem at the point of sale. It could be a proposer at the proposal stage, then a policyholder after issuance and during the servicing or claim handling, or a beneficiary of policy if there is an assignment of the policy, or a claim after the policyholder is deceased, etc. So all these people could be complainants, and all these people are participants who could be governed or who could be protected under the policyholder protection regulations. Then cover basically deals with the insurance contract, cover note or certificate of insurance, or other approved document by IRDAI evidencing a contract of insurance. Then distribution channel is basically any entity which is entrusted with the responsibility of sale or service of insurance. Then proposal form, it's basically a form to be filled in by the prospector in written or in electronic form or in other approved form for furnishing material information, and the material information is also given in another definition in the in an explanation to this definition, saying that it is important, essential and relevant information to enable the insurer to take an informed decision in the context of underwriting the risk. So the proposal form requires all the material information to be filled in, and it is on the basis of this information that the insurer will take an informed decision about what, whether to accept the risk or not to accept the risk, which is an underwriting decision. The second thing is, if he decides to accept the risk, what is the rate, what are the advantages, terms and conditions in respect of which he will grant the insurance cover. So this is the proposal form. Then prospect is basically a potential customer who is likely to enter into an insurance contract either directly or through a distribution channel. And prospectus is basically any document which is issued to solicit or promote insurance products in physical, electronic or any other format. An insurance product here includes a rider which is tied to the product or any standalone product. So these are some of the definitions that are provided for, and this is what I was referring to as the focus is now on a broad approved policy for policyholder protection, and there are 5 key elements that are there in this board approved policy for policyholder protection. The first is a commitment to insurance education, because insurance product is a product which is a specialized product, and it is a matter of solicitation to suggest the appropriate product for the insurer, and the risks and uncertainties that are there and the coverage and exclusions etc. that are provided for are very specific, and to prevent insurance information asymmetry, it is necessary to bring up the general level of education of insurance and also to come out with specific aspects relating to the product. So both these are provided for. While the general aspects of education are provided for in the board approved policy, the other provisions relating to the specific product are provided for in the subsequent provisions of the policyholder protection regulation. So here the policy should contain steps for promoting insurance awareness to educate about the products, benefits, rights and responsibilities of the policyholders. Then we wanted to have a citizens charter to be incorporated as a part, of course, giving the broad framework of it, but now what they have suggested is the citizens charter is something which has to be a board approved policy with the standard service parameters, including the turnaround times for specific services to be approved, and this approved citizens charter has to be provided on the website and it has to be updated periodically. In fact, the FSLRC requirement was to have minimum tax and then the insurers were supposed to, the financial services providers were supposed to have something better than what the regulatory minimum is provided for. So that's the reason why we thought we have a citizens charter, model charter, which we can provide, and then the insurers can have better systems by having reduced turnaround times, but that does not work. So now you have a citizens charter brought out as a part of the board approved policy. Then third, grievance redressal. The grievance redressal guidelines under the policyholder protection regulations were issued, indicating that you have to give an acknowledgement within 2 days. Then you have to resolve it within 15 days. So those timelines, 10 days, those timelines were specified in the guidelines prior to 2017. So now the guidelines have been done away with, and the grievance redressal is now supposed to be a part of the board approved policy, wherein the procedure for expeditious resolution of complaints is supposed to be incorporated. Then the emphasis on mis-selling, especially in life and health policies, was something which was taken cognizance of while coming out with this provision, saying that the board approved policy has to indicate steps to prevent mis-selling and unfair business practices at point of sale and at servicing of the insurance policies. Then since IRDA started the mechanism of having the unique identification numbers, etc., and giving the details of the products, terms and conditions, etc., it was indicated that the board approved policy also should factor this requirement, saying that the steps for informing the prospects or policyholders about the benefits, features, terms and conditions are supposed to be provided for on the website of the insurers. So this requirement is a very important requirement, and you try to match this with the requirement of IRDA coming out with the list of the products and the terms of conditions that have been approved. This can form a very powerful tool for the protection of policyholders' interest and to prevent any misstatement or misrepresentation in the company's product brochure and the IRDA's approved product. So I don't know how many of them make use of this facility, but I have tried to use this sometimes while I was dealing with certain grievances. Any doubts or questions at that point of time? Because I need to fill some water. Any questions? Am I going at a reasonable pace? Comfortable for comprehension?
Yes, sir. Yes,
Okay.
sir. Go ahead.
Okay. 1 minute, just give me a moment. So now we come to the various stages of insurance cycle and what are the protections that are provided for through the policyholder protection regulations. The first and the foremost is the point of sale. That is the stage at which you are inviting people to take insurance policies. So the prospectus, what are the requirements that are supposed to be stated, is the first set of protections that are given to people. But first is the unique identification number of the product by IRDA. Then what is the scope of benefits? What is the extent of cover? What are the warranties, exclusions, exceptions and conditions with explanations? So this is something which is very, very important. Then the contingencies covered, then classes of lives and property eligible for insurance. Then if there are any rebates on premium of renewal, what are the conditions and what are the rates at which these rebates are provided, that needs to be indicated. Then if there are any riders that are supposed to be provided along with the products, either tied or along with it as add-on covers, those details have to be furnished and what are the benefits of those have to be indicated. And in this, there is an explanation that has been provided indicating the limits on the riders and the sum assured in relation to the riders. The first of these is premium under health or critical illness riders should not be more than 100% of the premium of the original product. Then for all other life insurance riders, it should not be more than 30%. The premium should not be more than 30%. So it is as if you are selling the rider more than the insurance. That's the purpose. So same in the case, benefit under each of the riders should not be more than the sum assured of the basic product. So basically, it is like the product with the rider, which is supposed to be the secondary aspect. So through either the premium or through the coverage, this should not be over encompassing or overshooting the benefit that is provided for or the premium paid for the main product. That is the intention of setting these limits. And in case of insurance products, if it is a life insurance product, it has to be clearly indicated whether it is a participating product or a non-participating product, because your eligibility to get bonus will be determined whether it is participating or not, and accordingly there will be a small increase in the premium. So if you don't disclose this, then it will not be doing service to the customer. Then the insurer, agent or intermediary is supposed to provide all material information to the prospect to enable the prospect to take an informed decision. Then the next step is that the person is relying only on the insurer or agent or the prospect, then the person should be advised dispassionately. So this is an area where a lot of mis-selling happens. So most of the times people rely on the agent only for the information that is required, and they try to push the product that is being campaigned for by the insurer, and that is where the policyholder and his requirement becomes a casualty. So most of the times when 2010 and around that times, you find that there was a huge push for ULIPs, and it was these ULIPs which were the maximum missold policies that were there. Especially they were selling these products to people of 55, 60 and above. And the moment these people, the life cover of it was more, and if it is not sufficient, the product used to be closed. So the policy used to be closed because the premium is not sufficient to cover the provide for the life cover. So the promise of returns was also being made, because of which people were taking these policies merely because of the greed. If the life cover was more, then the amount of money that could go in for units was less, and automatically there will not be any interest that you would be earning on these products. So mis-selling was something which was rampant, and the various regulations that have been brought about for ULIPs were basically intended to deal with this vice, where the prospects were not being informed appropriately by the agents or the insurers. Then in case the proposal is not filled by the prospect, the insurer or agent should explain the contents of the form, and at the end of the proposal he has to indicate by giving a certificate saying that the contents of the proposal form and documents were explained and the proposer understood the significance of the proposed insurance contract. And I don't need to be we know how effectively this kind of a certificate works in insurance products, especially the life insurance products. Then another important area where there has been some complaint which came about was in the distance marketing sale. And for point of sale in the distance marketing mode, like by internet, SMS, telemarketing, etc., certain requirements have been specified in the regulations. One, that the person should be a qualified person or an authorized person only who should be making this interaction. Then he should go ahead and start canvassing his product only after obtaining a consent from the prospect. He must indicate that I am calling up from an insurance product company. I want to advise relating to a product. Should I go ahead or not? Then only he should provide the information of the insurer, product, benefits, conditions, etc. And he should do the entire sale process without compulsion, without inconvenience or nuisance of any kind. And we know that most of the times when we are sleeping in an afternoon after a good meal on a Sunday, the call that we get 9 out of 10 times is either an insurance company offering an insurance product or a credit card company offering a credit card, or the third option could be your existing banker offering you a home loan or a personal loan. So these are some things where you have a lot of issue, and distance marketing channels mostly operate on these timelines only. But the regulations say that they have to do these subject to these 4 conditions, that they have to seek consent, then they should be qualified persons, and then they should go ahead disclosing the insurance product and benefits, and then finally do it without nuisance or inconvenience. Then this is another regulation that has been added in the 2017 version. Products on offer withdrawn or modified, all this have to be placed on the website of the insurer at all points of time, and they should be kept updated. So every product approved by IRDAI under the file and use system, or every insurance product filed with IRDAI under use and file, those products along with those products which have been modified or withdrawn, and the list has to be updated at all points of time, so that there is a point of reference for the prospect whenever he wants to refer to the terms and conditions, or to see whether what he has been offered is something similar to what has been approved. Then proposal for insurance is Regulation 8. The proposal for any insurance is to be evidenced by a document, either written, electronic or other approved format, and the exception is only the marine cover or other covers approved by IRDAI. Then insurer's duty is to furnish a proposal copy to the insured within 30 days of acceptance. In fact, LIC was not complying with this requirement for several years, and now of course they have also started complying with these requirements. Then marine insurance, the insurer to record the information obtained and confirm the same within 15 days. The onus of proving any suppression of material information not recorded is on the insurer in case of a marine insurance policy. Then the next, in case of life insurance, it is very important to state the requirements of section 45. What is section 45? It is a section which makes it mandatory, gives the protection, saying that if within 3 years of the policy being issued, if any negative aspect relating to the non-disclosure is not brought out by the insurer, then the insurer is prohibited from rejecting the claim. So the non-disclosure of the policyholder becomes very, very important for the period of that 3 years. If within 3 years the insurer is able to catch you and say that you have not disclosed, then he can repudiate the insurance contract. But if the 3 years period has crossed, then the insurer has no recourse. Earlier there were certain grounds before 2015 amendment to the Insurance Act, there were certain grounds like misrepresentation, fraud, etc., where they could be proved and that period could be extended. But after 2015, what they have done is they have specified that it is the maximum of 3 years period within which the insurer is supposed to prove the non-disclosure by the insured. After the 3 years period is over, there cannot be any ground for repudiation of a policy. So from that point of view, when you are doing away with a right or you are making someone liable, disclosure about the responsibility has to be made, and that is what is the requirement of section 45S. Then the proposer to be guided by the provisions while answering questions in the proposal form. So while he is making disclosures, he should remember at the back of his mind that there is this section 45 of the Insurance Act, and if he gives wrong disclosures, he could be liable for the penalties which are there in terms of non-repudiation or rejection of the proposal, etc. Then there is a requirement for availing encouraging nomination and informing the provisions under section 39. So this as well as assignment, the general three things that are included in a life insurance policy are section 45, then section 38 and 39 dealing with assignment and nomination. And the fourth section is section 41, which talks about rebates, prohibition of rebating. So these are invariably incorporated in every publicity material as well as proposal and the policy document relating to life insurance. Then processing of proposal by insurance. Once these details are given and the proposal is given, the insurer is supposed to process these with speed and efficiency, and the decision has to be communicated within reasonable period. And this period should not be more than 15 days from the date of receipt of proposal, or in case they call for any additional requirement, from the receipt of that requirement. And any proposal deposit that is made, that has to be refundable within 15 days of making this decision. And if there is a delay beyond 15 days, then penal interest at the rate of bank rate plus 2% has to be provided for the payment without the customer asking for it. So this is as far as the proposal is concerned. Now let us see some instances of regulatory action for non-compliance. So I've just happened to skim through a few of these orders which have been issued by IRDAI relating to the inspection and penalties, etc. So the first case is relating to Tata AIG. The on-site inspection of it was done in 2018, and it was found here that the product was sold by Tata Capital, which is a corporate agent of Tata AIG. And then they violated the point of sale regulation, related PPHI regulation. They collected renewal premium of 3 years in advance. And this 3-year premium that was taken in advance was given as a loan by Tata Capital. And what did they say? That they collected this amount. The insurer said that I collected this information in good faith only to ensure that there is a timely renewal and to avoid the lapsing of policy. And when they asked him that why did you collect interest for that from Tata Capital, and was he being informed about the fact that he is paying up this renewal premium, then they said that the Tata Capital providing interest for this person is something which I am not aware of, because it is the corporate agent who has done it and I have no knowledge about it. But they indicated that since you pointed it out, I have discontinued with this practice. So IRDAI has indicated that you didn't take any consent from him for providing him with this beautiful facility that you have so-called represented to him, though at a rate of 13% of interest. So collection of renewal premium from agent is not transparent, and there is no informed choice of the customer. So since you continued with this practice for 292 days, ideally you should have been penalized at the rate of rupees 1 lakh per day. But since the maximum penalty that can be imposed is 1 crore, IRDAI went ahead and imposed a penalty of 1 crore. So there is a similar case relating to SBI Life in relation to one product where 2 years premium was taken, and the second year premium was given as an interest by as a loan by SBI. And in that particular case, IRDAI came out with a decision saying that you will have to pay back the money. Then the commission that the agent is supposed to be receiving, that was very high. So you will have to pay back that amount that you have received as commission also. And this matter went all the way up to the Securities Appellate Tribunal. And finally, it was decided in favor of IRDAI insofar as the practice of SBI Life and SBI SBI is concerned. But they also indicated that IRDAI's requirement of calculation and other things was not proper. So you go ahead and calculate how much money is supposed to be paid. Accordingly, it has to be paid. So where there is an involvement of a corporate agent, which is a financial entity or a bank, providing them with a finance for renewal of the policy is sometimes looked upon as an improper practice, provided you don't, provided you take the customer's choice also. Otherwise, what he is doing is for a premium payment, he is also paying interest, and accordingly his burden of financial liability will be increased. And this is a problem in case of bundled products with home loans also. If I am going to take a home loan and I am going to take a policy of home protect or something like that which is offered, what the banks are doing is tying these two, and they will be incorporated in the total loan amount. So now what will happen is the burden of this 50,000 rupees that is being paid as premium will extend for the entire loan period, and imagine how much money he would be paying. So these are the problems that are there with a banker and the financier having expressing more interest in the consumer's insurance product rather than what is justified. So this is where advice and the financial aspects have to be made upfront to the policyholder, in which case he will decide whether he'll pay up that 50,000 and avoid the 25-year liability on that 50,000, or he will take that liability because he can't afford that 50,000. So that kind of choice has to be provided, and if it is not provided, then you will have regulator who will pick up these kind of practices and then impose penalties. Hope I have made my point clear. Is this clear?
Can I raise a question here?
Yes, sir.
I mean, by allowing banks to become corporate agents,
yes, sir,
financial entities, hasn't IRDA allowed them, put them in a situation where there will be conflict of interest?
See, ideally speaking, there should not be a conflict of interest in the sense that there are certain requirements. This is basically, we must look at banks being allowed to be distributing insurance and mutual fund products as a mechanism for providing multiple financial services from single doorstep. So which is a very good thing if it is done properly. But the problem is,
what I'm trying to say is that, see, as an agent, they have to be faithful to that insurance company. As a banker, they have to be faithful to the customer. So as a banker, they are trying to provide insurance coverage to the customer. But as an agent of the insurance company, they're trying to pay the premium on time or whatever it is. So they cannot be faithful to both the person. There has to be conflict of interest for the simple reason the commission which the banks are making. And I'm telling you, because the situation before, when the banks were not having this, license, and how the situation deteriorated thereafter, after the banks became, they also had this interest. So basically, by allowing the banks, whether IRDA had thought of that or looked into this or not, but now when they are seeing that these interest of, and this is not just isolated things, this is happening all the time. I mean, the two interests clashing together, and the customers are always short-charged. The customers are always.
The problem is that.
I just thought I'm not asking for it. I just thought
no. The point
we had a tie-up with Punjab National Bank, and for the customers of Punjab National Bank, we created a royal health insurance scheme for them. And I was dealing for a time with that. I found that I mean, the customers said they don't know who is actually there, have their interest in mind, whether the bankers or the insurance company. So I just thought I'll point out this thing.
The point is, here also it doesn't say that you don't do with it. The problem here is that are you disclosing it to him? So here we are entering into a realm where I am supposed to indicate that I am, in case of that SBI, if it is a single premium, then it will get 2% commission. But what they did is they made 1 year and a renewal premium to be given so that the commission will be 25%.
That is the thing. That is the thing. No? That is the thing. No? They try to have more, get more.
So that's the reason why what we have to ensure.
And second point is initially a banker could have only one insurance. I mean, they can be agent of. Then they allowed multiple. Then they compounded the, whatever the problem was, they compounded it.
But ideally now, even though there is being corporate agents, banks are able to take from 2 life, 2 general and other things. Basically, most of the banks are dealing with their own setup entity, because of which this second entity probably is generally, it's not much useful for them. The other problem relating to these is in terms of the customers not understanding. If you see most of the cases that I have handled while I was an ombudsman, while I was in the ombudsman office in banks also, that this along with the so many 70-80 pages of the loan document, there will be one single sheet with SBI on top, but SBI life insurance on top of it, and there will be one policy where they will say that 70,000 rupees premium for home protect, and they will sign, and they will say that this interest is more than what I have accepted. Then you will find within the papers this document that there is this home assured protection, and he won't receive the policy also. Those were the instances, and that's the reason why disclosure of that, and also disclosure of the fact that I am providing you with this benefit and you are filling this form for the purpose of this. If that is done, then probably you will have this conflict situation will not come, and the conflict is much more these days because instead of having targets for deposit acceptance, banks have target, or bankers have targets for insurance policies and for mutual funds, because of which they don't have any interest in selling you an a term deposit. They will be more interested in packing you with a mutual fund or an insurance policy. That's the reason why all the more the mis-selling pressure will be more. That's the reason why we need to also look at the problems relating to mis-selling will be most in brokers, because they will be operating through their operatives who are operating through the call channel. You will not find broker who will physically approach you and mis-sell a policy. But through the telecalling channel, there will be a lot of mis-selling things which will happen, where broker will be at the end of the chain. The second important segment of mis-selling will be through the bank channel, where automatically, unsuspectingly, a customer of the bank will be lured into an insurance product which he either does not know of or does not want, or which is not fit for him also. So that's the reason why there is this problem, and the fact that now you have an insurance ombudsman who is competent to decide on it, and the banking ombudsman also who goes ahead and decides on it. Probably you will have lesser and lesser. In fact, definitely, if you see the time when I was there in IRDA, there were close to 210,000 complaints on unfair business practices. The latest of these, I find that there are only about 50,000 to 60,000 unfair business practices complaints. So, thanks to the various measures that we have taken in terms of educating people and also warning the banks and other brokers and other things, we have been in a position to bring down. But the trust in insurance will be more only when we bring down this mis-selling to very, very low levels. But that should happen also with the consumers being aware, because they also need to understand what insurance is all about. Not simply put there, just like Bitcoin, people are falling prey. They used to go and say that 5 साल में आपको 50,000 मिलेगा, 5,000 पे करेंगे, so they will sign up for a ULIP policy. So if tomorrow Ukraine happens and something else happens, automatically the markets will go down. And if it is a 25-year person, he will have at least some units. If it is a 50-year person, then he will not have any units, and where he will get the money? Nothing. So these are some of the issues, and the regulation provides for it, though in practice, implementation of it is something which is lacking. And that is where probably if the inspection machinery and the monitoring machinery is focused on this, probably you will have better results in terms of disciplining in compliance. But if that is not there, then automatically people think that they can run roughshod over the customers. Then the next, this case was a Max Bupa case. So there was a delay beyond 15 days in deciding on a proposal. So the company indicated that due to calling for further details from the customer, communication was sent to customer within 15 days stating the reason for delay and calling for further information. Then IRDA accepted the response and advised the insurer to comply with the regulations in true spirit. So the other one is a claim related one, but that let us not deal with it now. So in this way, there was no penalty that was imposed, but it was accepted, and IRDA condoned the issue. There is another case of SBI Life where in an on-site inspection it was found that information about section 41 and 45 of the Insurance Act were not properly reflected in the proposal. Then the insurer replied that the proposal, sales literature and policy document were updated and the case is cited by IRDA. So basically this is a case where I need to build in a new set of documents after the regulation comes into force. IRDA gave them a time also, but beyond that time also, if they were using the old document, IRDA indicated that I don't accept your response. So even 2 years after the amendment coming into place, if you are not modifying your proposal and other documents to reflect the statutory position, which is intended for the benefit of policyholders, I won't accept this, and they imposed a penalty of 4 lakhs. Penalty of 4 lakhs for 4 dates on which 4 such proposal forms were signed. So here the proportionality was 1 lakh for 1 day. Then they were directed to ensure non-recurrence of such lapses. Then the next instance is in relation to Star Union Daiichi. So here the non-disclosure and proposal relating to about existing cover and section 45 related. So here the reply of the insurer was, they have indicated that had the insurer disclosed the existing policy, the policy would have been denied as a high risk case, and extra due diligence was taken by calling for further documents. So no information was at the time of taking up the claim, only active engagement was made. So the claim was rejected by the insurer, and subsequently the ombudsman also upheld the claim. However, the claim was paid only during the time the matter was taken up for the permanent Lok Adalat. Then IRDA examined this matter and it indicated that I don't accept the response that you have given. The due diligence that you have taken subsequently should have been exercised at the time of underwriting rather than doing it at the claim stage, and they imposed a penalty of 1 lakh on the insurer, and they have indicated that all the sales personnel have to be trained so as to guide the prospects to disclose all material information and avoid unintentional non-disclosure, so which will be jeopardizing their interests subsequently. So these are the instances relating to the proposal and the point of sale stage. Now the next 3 regulations talk about what are the matters that are supposed to be stated in a life insurance policy, what are the matters to be stated in a general insurance policy, and what are the matters to be stated in a health insurance policy. So I will not go largely into the details of it. So basically the life policy has to clearly indicate what are the particulars of the insured, what are the nominees particulars, what are the premium payment particulars, what is the date of risk maturity, and what are the dates of receiving survival benefits. Then the details of the product and whether the product is a participating product or not. Then how will the profits be distributed if it is a participating product, whether it will be through cash, whether it will be through reversionary bonus, etc. Then what are the benefits and contingencies on which the benefits are payable, and what are the riders that are attached. Then they are also supposed to indicate in what instances are you going to make the policy a paid up policy. What are the events in which you can surrender the policy, foreclose the policy, and what are the terms relating to non-forfeiture or discontinuance. So these terms are very important. Sometimes I don't want to continue for the full term, so I may say that now stop. I will treat it as a paid up policy. So then the second thing is I will continue it in a paid up policy. I will continue it for that sum assured instead of the original sum assured that I thought of. In case of a surrendered policy, I will say that from now on, discontinue my policy. And these aspects, what are the terms relating to it? Those have to be disclosed so as to keep the policyholder informed. Then contingencies excluded from policy and riders. Then what are the special exclusions and conditions? Then what are the provisions relating to nomination, loan against policy, assignment, etc. Then the need of notification of changes. What are the changes that are important to be notified to the insurer? That have to be specified. Then the address of the insurer for communication and the details of the grievance redressal mechanism, address of the insurance ombudsman, etc. have to be given. Then in addition to it, most importantly, what are the documents that are required for claim under the policy? And most of the policies do have the claim documents also enclosed with it so that they can be furnished if and when the need arises. The most important provision that is there relating to life insurance policy is something called as a free look. I personally indicate this to be an extension of the principle of utmost good faith. So the provision relating to insurance policies in life and health go beyond the utmost good faith. So if you go through the policy and after you receive the policy also, if you are not satisfied with what you get, then you can return the policy. And what is the time period that is provided for return? Am I online? Am I audible?
Yes, sir. Yes, sir. Yes, sir.
So in case of
very much.
Because again, I had some alert of network not being very comfortable. Okay. So in case of a distance marketed policy, the time period that is available is 30 days. In case of other policies, within 15 days from the receipt of policy, the insured or the policyholder is free to return the policy, saying that the policy does not comply with the terms and conditions that have been specified to me at the time of sale. And what are the reasons for objection? He will have to state and then return the policy. And after the return of policy, he is entitled for refund of premium. The only eligible deductions that can be made out of it is the proportionate risk premium for the period that the policy has been in vogue, then stamp duty that has been paid in respect of the policy, and if expenses have been incurred by the insurer for medical examination of the policyholder, those expenses can be recovered. The remaining amount has to be paid and the refund has to be within 15 days of receipt of the request. Then in case of linked policies, because units are given, the units are repurchased on the cancellation date and above amounts will be recovered. So this is as far as the free look cancellation of a life policy. The next regulation talks about matters to be stated in a general insurance policy. So here again, particulars about the insured, then contact details of the agent who sold the policy, then location of the policy, interest and the insured value. Then what is the product? What is the period of insurance? What is the sum insured? What are the perils that are covered and not covered? Whether there is any franchise, deductible, etc. Then the most important aspects that need to be stated here is in terms of premium, whether there is any adjustment that is possible in the premium, and if so, what is the basis of adjustment? And the most critical aspect relating to policy terms and conditions is the conditions, exclusions, etc., which become very, very significant in the general insurance policy. Then any special conditions that are there, then what should the insured do in case of an occurrence of contingency giving rise to a claim? Then what are the obligations of the insured with respect to the subject matter of insurance, and what are the rights of the insurer? These have to be specified. Then there could be instances when the policy could be cancelled. What are the grounds of cancellation of the policy? Those have to be indicated. In case of a retail policy, the only grounds of cancellation are misrepresentation, non-disclosure of material facts, fraud and non-cooperation of the insured. For commercial policies, there could be other factors also which could have a bearing on the cancellation of policy. So these are as far as the matters to be stated in a general policy. Then in addition to it, they also have to indicate the details of endorsements, add-on covers if any. Then if there are any changes in the premium on renewal, what are the changes, what could be the changes or the benefits, and what are the conditions for renewal, they have to be specified. And last but not the least, the address for communication and the grievance redressal mechanism details have to be furnished. Then the next is relating to health insurance policy. Here the most important aspects that need to be given again are policy terms, conditions, exclusions and warranties. And in addition to that, in health insurance, the most important aspects are the sublimits for various items, then proportionate deductions and whether there are any package rates, what are the rates for them. Then waiting period for pre-existing disease and specific ailments. Then there are requirements of co-pay, then general or specific deductible, those have to be indicated. Then what is the mechanism of bonus, what is the cumulative bonus, etc. Then the premium and periodicity of payment. All these details have to be indicated in addition to the details about the policyholder and the beneficiary details. Then the next is the details of TPA. Then the free look period and the portability conditions have to be indicated. Then the facility of migration of policy and conditions for migration and portability, they have to be indicated. Then provisions relating to cancellation, etc. have also to be indicated. Apart from this, what are the fact that the benefits and the premium are subject to change on renewal, this has to be indicated. Then the address of insurer and the grievance redressal mechanism, they have to be specified. So these are the three areas relating to matters to be stated in life insurance policy, general insurance policy and health insurance policy. And this regulation that is now that I am going to now indicate is a regulation that has been added in the 2017 version, where we have wanted to specifically focus on exclusions and conditions which are specific for general insurance and health insurance policies to bring more emphasis into it. So the provision says that the insurer is supposed to classify exclusion of policy. They have to indicate what are the standard exclusions applicable to all policies. Then for the specific policy that is there, what are the exclusions that are available, that are applicable. Then what are those exclusions which can be waived, and what are those exclusions which cannot be waived. And those exclusions can be waived with the payment of additional premium. They have to be specified. So categorization of exclusions for greater clarity is something which was intended to be brought about through this provision. Then policy conditions also, the classification of those conditions was supposed to be brought about to bring about more clarity for understanding of the policyholder. That is, what are the conditions precedent that need to be fulfilled prima facie to be eligible for insurance cover. Then what are the conditions during the contract to make them eligible for the continuance of insurance cover. Then what are the conditions that need to be fulfilled when the claim arises, and what are the conditions for renewal of contract. So this way, the classification of exclusions and classification of conditions was intended to be brought about to make it more clear for the customer. Then insurer to inform the insured of the requirement for lodging claim and procedure to be followed for early settlement. So not wait for the customer to come, but keep him upfront posted about the requirement for lodging the claim and procedure to be followed. Then the next three provisions talk about the claim procedure relating to a life policy, procedure relating to a general insurance policy, and then relating to a health insurance policy. Any doubts or questions up to this point of time? They are very self-explanatory in a way, but still, for a breather, let me just pause. Yes.
Mallikarjun sir, you have told that section 45, section 38, section 39 and section 41 is available only in life policies, whereas that section 41, prohibition of rebates, is also available in general insurance policies also, sir.
Yes, sir. Yes, sir.
Is available. Only that section 45 is not available in general, and even 38,
39 are available even in life. But the emphasis is more on life insurance policies where these disclosures have to be made, because assignment of life insurance policies is a very important area. Nomination is very important from the perspective of relieving the insurer of the nonsense of keeping this money for eternity. And then the third and most important thing is the right that is available for a customer and the right that is available for the insurer, which undergoes a drastic change under section 45. So from that point of view, it becomes very, very important. So these three, I think even in general insurance policies, you need to mention 30, 39 and 41.
Yes, yes.
Okay. So in fact, when I was there in IRDA, we drew up the standard nomenclature that is supposed to be there and then circulated it to insurer to be incorporating the same in their documents. So that was something which we did while I was there in IRDA. So my energy levels are going down. So maybe before I drop, I'll get on with the matters relating to general policy. Okay, I mean claim handling procedure. So the claim handling procedure, the first requirement is that the death claim should be processed without delay. So any queries or documents required to be intimated have to be intimated within 15 days of receipt of the claim. So generally it has to be done in one go, and periodically you shouldn't keep asking for documents which are unnecessary, etc. Then once you receive all the documents, within 30 days, the company has to decide whether they will pay the amount or they will reject with reasons of receipt of from 30 days from the date of receipt of all information or documents. Sometimes it may so happen that there are suspicious circumstances attached to the death, and there could be instances where the death claim is a very early death claim, that is within 2 years or within 1 year if it happens, or if the premium amount is very high and the claim is early, not premium amount, the sum assured is very high, and then there is some needle of suspicion, etc., in which case the insurer can go and take up an investigation. So where there is a need for investigation, the time period that is provided for is 120 days in total. That is 90 days from the receipt of intimation, the investigation has to be completed. And the decision to pay or reject has to be taken within 30 days after the investigation report is received. So in case there is any delay, interest at the rate of 2% above bank rate from the date of receipt of last document has to be paid. Then these are instances sometimes you may not be in a position to identify the payee, in which case the claim plus interest at bank rate from the date of the claim will become payable as and when the claimant is identified. Sometimes there is a dispute between people, in which case it has to be kept in the court and the amount is supposed to be paid to the court. So in that case, interest is also paid and it will be decided based on the decision of the court that the final money will be disbursed. So these are the instances where the payee is not identified or there is a dispute in relation to the payee. Then it is not only in relation to the life claims, but there could be survival benefits or annuities which are supposed to be paid under the life insurance policies. There also the insurer should send a notice well in advance, or these days what you have is you have EFT or other details which are already provided for. So even before the due date, the amount is supposed to be paid, or so that the money is available on the due date. Then for delay, an interest again at the bank rate plus 2% should be paid. So where there is a free look cancellation, or there is a surrender of policy, or withdrawal, or refund of proposal deposit also, the amount has to be paid within 15 days of submission of the last document. And the delay beyond 15 days, interest has to be paid at 2% from 2% above bank rate. The bank rate will be the rate applicable at the beginning of the financial year of the year in which this claim happens to come about. Then this interest payment is not supposed to be made only when the person asks for it, but if the company knows that there has been a delay, it has to be paid along with the amount without waiting for a specific demand. Then there are certain instances. Future generally inspection, it was found that the payment, there was a delay in settlement of death claims. Then the payment was pending for want of bank details is what the bank said. Then they have indicated that the systems have been improved, and they submitted the age-wise analysis of claim. And they also indicated that they paid penal interest. So IRDAI noticed that the insurer has not ensured compliance with regulatory regime, but considering the submission and also the progress that the insurance has shown after the mistake was pointed out, they indicated that I am not going to press for charges, and they didn't impose any penalty. Then there is another case. In this particular case, the insurer, which is India First Life, they came out with a pre-underwritten term policy for employees of a motor dealer of up to 20 lakhs. So they indicated that there is no need for a proposal form and no details of previous policies are required. Only a declaration is sufficient. And then they went ahead and repudiated the claim, saying that they didn't give furnish the details of the policies that they had. So the insurer indicated in its reply that the death alleged due to sunstroke was suspicious, and the details of multiple policies was not given, and the person was not eligible for a sum assured of 88 lakhs based on the human life value. So then IRDAI indicated that you didn't go into any of these things at the time of underwriting. So you went ahead and simply accepted the proposal. So now regulation of informing requirement of additional documents has to be done within 15 days of claim that you have not complied with. Then advisory was given to re-examine the documents and decide and inform IRDAI within 3 months. So they didn't say that you go ahead and pay the amount, but they indicated that your underwriting guidelines and other things were not appropriate, and you didn't have proper systems in place. So you deal with them and you come out with appropriate steps. So this is as far as the that particular claim is concerned. Then in Bajaj Allianz Insurance also, they found that a large number of pending claims were there based on the aging analysis. So looking at the compliance, IRDAI let them go with only a warning. Then another case where free look cancellation was done beyond 15 days and refunding more than the premium. The company said that I am doing it basically in the consumer's interest. And in no case the money more than the premium was informed. So then IRDAI indicated that you have proper controls in the policy dispatch and allow genuine free look cancellations based on the date of receipt. And then they drop the charges. So this is as far as the regulatory action is concerned. Then same no action. So you will find that there are not many cases where IRDAI takes very serious action either in the general insurance space or in the life insurance space for delayed action. And action in these cases sometimes happens at the insurance ombudsman level, where they will indicate that you pay the penalty in accordance with IRDAI's guidelines. So those kind of things will happen at the insurance ombudsman level. Then the next provision is relating to claim procedure in respect of general insurance policy. So this has to be read in accordance with section 64 UM of the Insurance Act also, which talks about surveyors, etc. So first, a notice of loss arising under policy is to be issued at the earliest. However, condoning the delay on the part of insurer can be done by the insurer. Then on receiving a communication, the insurer should immediately respond and indicate the procedure that is required to be followed by the policyholder or the claimant. And he should go and appoint a surveyor for assessing the loss immediately or in any case before 72 hours of the receipt of the claim intimation of the loss. Then the surveyor details and the role and duties of the surveyors and the responsibilities have to be communicated by letter, email or any other mode to the policyholder or the claimant. Then what should the surveyor do? Immediately he should inform the policyholder or the claimant about the documents that are necessary to be submitted in support of the claim. Then where the documents can be obtained from the public authority, he need not ask for them. So it means that if it is available from the public authority, the surveyor himself will go and collect those documents. Then he should not call for any document or information which is not relevant to the claim. Then he should advise the insured or claimant in writing that there would be a delay in assessment of claim. In case he does not furnish all the particulars to the surveyor or he does not cooperate with the surveyor. So by having this clause only, the surveyors can ensure that the policyholder or the claimant is warned prima facie that it is in his own interest of timely resolution of the claim, that he should cooperate with the insurer and the surveyor and provide all the information that asks for. Then follow up for pending information and documents guiding insured and the claimant. So the insurance surveyor is supposed to facilitate and follow up with the insured, and he should give notices to the claimant and the insured saying that now you have not given the document, so your claim will get delayed. So it is your responsibility. So this kind of communication has to be kept in the surveyor and the insurer's own interest to be not charged for a delay in settlement of claim. Then the next and the most important part is the survey has to be commenced immediately or within 48 hours of the appointment. And this is one change that has been brought about in the 2017 regulation, that an interim report to insurer giving physical details of loss within the shortest possible time from the first receipt is supposed to be given. So this interim report provision has been brought about in 2017, which was not there in the original 2002 report or guidelines. Then final report is to be submitted by the surveyor to the insurer, generally within 30 days of appointment. So where there is a commercial and a large risk, then the report has to be submitted within 90 days of appointment of the surveyor. Then the insurer should furnish the interim report or the final report to the claimant if so desired. Then on receipt of the final report, the insurer has to settle the claim within 30 days of receipt of the final survey report or the last relevant document. Sometimes the insurer finds that the survey report is incomplete, then he will have to ask the surveyor for an additional report indicating specifically the issues on which he wants the report, and this request has to be made only once for a particular claim. And once insurer asks for this additional report, then the surveyor has to give this report within 3 weeks from the date of communication from the insurer. Then the surveyor should seek extension of time for submitting report from insurer on specific circumstances, if it is a complicated claim or if there are difficulties in replacement or reinstatement. And in these cases where he is seeking additional time, the insurer is supposed to keep the insured or the claimant updated of the delay and the progress in respect of settlement of the claim. And at this time, the insurer can also take a decision whether to make a provisional or on account based payment on the claim liability. So where he is admitting the claim and he is only interested in deciding about what is the quantum of the claim based on the surveyor report, then the insurer can make an on-account payment to the policyholder. Some of the insurers have started doing this. Not that they were doing it probably after the 2017 regulation, but in good customer service, they should be doing this, where there is so as to provide some succor to the policyholder or the claimant who is already suffering a huge loss. Then, after receiving the final or additional survey report and any other documents, the insurer is supposed to make an offer for settlement of claim to the insured or the claimant. So in this particular offer, he has to indicate what are the amounts that are paid, what are the amounts where there is a reduction in the amount of admissible amount in relation to whatever has been claimed, and this reduction in amount will be a point for arbitration, because most of the arbitrations are only quantum disputes rather than the liability disputes. Then if they have to reject the claim, they have to reject the claim by recording the reasons in writing and communicate the same to the insured or the claimant. And this they have to do within a period of 30 days from the receipt of the final or additional survey report or documents as the case may be. So wherever there is any delay beyond this period, they are supposed to pay penal interest at the rate of 2% plus bank rate. This is as far as the claim procedure in relation to general insurance policy. So here there was a case of Future Generali India Insurance, delay in appointment of surveyor and no written communication of appointment to motor claimants. So the company replied that the delay was on account of insufficient information by claimant. The client was not available. There were holidays and weekends. Then the client was informed promptly of appointment. So then IRDA decided by only giving a direction to the company to ensure appointment, and directed the company to give proper guidance to the claimant and for sending an intimation of appointment. So it merely went by a direction. Then there was another case where IRDA gave a more comprehensive set of directions, and that was in relation to a case where it was observed that in the claim payment for motor vehicles which are lost, where one key is duplicate key is not provided, the insurer was reducing 0 to 30% of IDV while they are making claim payments. So here IRDA said that there is an inconsistency in approach, and what you are doing in terms of reduction is in an arbitrary and non-transparent manner. So then the company replied saying that the shortcomings like no keys being available, no police complaint, etc. were observed in these cases. Ideally, the company could have repudiated the claim for breach of material condition, but it was settling the claim based on the standard operating procedure of the company and after investigation and discipline. To inculcate a future discipline, the company was making a deduction of this 0 to 30% of IDV. And they have also indicated that there are very few claims of this nature. Then based on this response, IRDA gave directions relating to how to deal with these kind of instances. So IRDA directed the insurer to have a board approved policy for non-standard claims. So if it is ideally it should have been rejected, but as a service it is being done, so it is a non-standard claim. So have a board approved policy for that. Then have a more comprehensive standard operating procedure to enable uniformity and consistency in claim deduction. So where you are doing 0%, where you are doing 30%, make the parameters very clear so that the people will get to know. So maintain transparency through communication to customer, informing the policy condition and giving the rationale. Then educate and orient the marketing staff, the prospect and policyholders, that they need to keep the original keys at the time of making the claim. Then inform about keys and timely intimation regularly. Then ensure deduction from theft claim is transparent and consistent after communicating the rationale. So this set of directions were given by IRDA for dealing with these kind of claims based on the inspection finding that they found there in future generally. Then there was another instance where the case was in relation to ICICI Lombard. The benefit of discount provided by the network provider was not passed on to the policyholder, so thereby not enhancing the sum. This is in case of a health insurance policy. So the network provider was providing a discount and this discount was not passed on to the policyholder. So the impact was either enhancing the sum assured, and where there was no claim, there was no way in which he was benefiting out of it. So the insurer indicated that he will restore the sum assured of the 14 lakhs policies where the amount has been exhausted, and whatever balance amount is remaining, they will identify the claimants and distribute it to them. So IRDA gave them a direction saying that you rework all the claims where discount was received and refund the discount received to the claimants with interest. So this is a case where the hospital is giving a discount, but the discount is not getting transferred to the policyholder. One, either as a benefit to in terms of enhanced policy amount, or in terms of a benefit which is passed on to the customer. So IRDA indicated that you pass on wherever the customer is identified, you refund the discount to those claimants and don't keep the benefit that has been provided by the network provider to yourself. So this is a case where regulatory action was indicated. Then there were two other instances where Bajaj Alliance delay in claim, charges not pressed, only an advisory was issued. Then in New India Assurance, there was one case where IRDA imposed a penalty of 3 lakhs and asked for payment of penal interest, where there was a huge delay in terms of receipt of survey report. Okay, so this is as far as the regulatory action for non-compliance. Then in United India Assurance case also, delay in appointment of surveyor and submission of survey report and delay beyond 30 days in making offer. IRDA, after the explanation from insurer, observed delay in 12 sample cases and they imposed a penalty of 5 lakhs. So you will find that progressively after 2017, you have instances where IRDA is imposing penalties, giving directions and making it more stringent for the insurers to comply with the requirements and the deadlines as far as general insurance policies are concerned. As far as the health insurance policies are concerned, the regulations of health are applicable for dealing with these claims. The time period for settlement is 30 days from the date of receipt of last document, and penal interest at 2% of bank rate has to be paid for delay. So these, in case where the investigation is warranted, claim 30 days period for investigation and 15 days for payment. So a total of 45 days. If it spills over 45 days, then penal interest at 2% above bank rate. And where there is a return of premium on pre-look cancellation, the delay beyond 30 days, an amount of penal interest has to be paid in those cases also. So these are some of the regulations relating to handling of claims relating to general, life and health insurance policies. The next provision is relating to grievance redressal, which I will talk to you in the next session. Then the other regulation talks about the power of chairperson to give clarifications or guidelines in interpretation of the provisions. Then the most important provision here, which has been incorporated, is one relating to general principles, where it is indicated that insurer has to inform the policyholders annually of the bonus accrued on policies in participating policies and the value in case of ULIP policies. This was something which was very important because a lot of people in ULIP policies had the policies but never knew, got any intimation from the insurer about anything to do with their policies. So the intimation of this value of ULIP policies was one mechanism to indicate to people about the having of these policies and the value that is there in the policies at that moment. So this is a new provision that has been incorporated. Then this was there in the earlier system also, that the obligation to disclose material information is not basically on the insurer and his distribution channels only, but on the insured as well. Then the policyholder to assist the insurer for recovery of claims against third parties and furnish all information sought to assess the risk covered in the proposal. This is basically to ensure the right of subrogation, the principle of subrogation to be operated smoothly, where the insurer pays up, but the insurer has to recover from someone else. There the policyholder has to assist the insurer for getting the claims against third parties. Then insurers to ensure confidentiality of policyholder information by disclosing information not to anyone other than to those authorities which are statutorily required as per law. Then any breach of obligation by insurer, distribution channel or surveyor is liable for action jointly and severally by IRDAI. So IRDAI can take an action against the insurer also and against the distribution channel or the surveyor also. So these are the provisions relating to the protection of policyholders' interests, and I have also tried to give you some information about the instances where IRDAI has taken varying types of action, sometimes giving a penalty, sometimes imposing a penalty, sometimes giving them directions, sometimes giving them a comprehensive mechanism to deal with similar such instances, sometimes letting them go with a warning. So these are some of the aspects. So the more you go into IRDAI website and see the regulatory action instances, the more you will find the divergence that is there in terms of the actions that have been taken. But with the adjudication procedure and other things coming in, now probably we have reached a stage where there is more alignment in terms of penalties which are imposed by IRDAI. So someone can do a research on that to find out, especially if someone has to do a research, do it on the management expenses, what actions IRDAI has taken starting from 2002 till date, because that happens to be a very important provision of regulation of insurance companies. Management expenses, limits on management expenses. It's a very important area. Maybe if I have time and if I, move out of my job, I will probably take up that as one of the exercises. What is the provision under the Insurance Act? What are the provisions under the insurance rules and regulations, and what is the action that IRDAI has taken against various insurers? That is an area where you can do some study. So any doubts, any questions, any feedback?
I believe it was a very exhaustive.
It was I got very exhausted also, sir.
You got exhausted, yeah, because it was very exhaustive. So any questions? We'll take just one or two questions only, keeping in mind Dr. Malika Arjun's energy level. There doesn't seem to be questions, but
sir,
nevertheless,
I have a question.
Yes.
Sir, I like to know, after making settlement, what is the scope of arbitration?
Sir, settlement, acceptance of settlement will not make you, ineligible for bringing about that dispute. So that has been indicated time and again, saying that yourself, because it is do or die kind of a settlement that is being given. No? So you say that you put your signature against this settlement or you will not be given any claim. So at that stage you put your signature. So subsequently, if you find that what is appropriate, there is a difference between the amount claimed and amount paid, there will always be a dispute of quantum dispute, and you can take it up for arbitration. I personally find that there should not be anything wrong in terms of initiating an arbitration dispute. Even after saying that I am conditionally accepting this state settlement, then you take the money and then initiate a dispute relating to arbitration. Or At the stage where you are getting the settlement itself, trigger an arbitration. That will be the ideal thing. And that will facilitate the entire process to be completed fast also, because you will have the urgency of getting the money and you will drive the arbitration process faster. Ideally speaking, the settlement offer which does not provide full settlement can be a direct reason for triggering of arbitration proceedings.
Thanks, sir.
Yes, sir. Thank you.
Any further query?
Anything else?
I think we'll call it a night.
Yes, sir.
Thank you very much, Dr. Mallikarjun, for your elaborate description of this very important regulation, especially for us people and those who want to go into arbitration. This regulation, you have to know it by heart. You kindly go through this regulation again and again. You have to understand every aspect of this regulation, because this governs the entire underwriting and claim settlement. If an insurer doesn't know this regulation or doesn't practice this regulation, they will be in trouble.